We're jumping straight into Planet Labs today. Everyone is watching the price action, but the real story is the massive 33% revenue acceleration and the triple-digit surge in their backlog.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And the momentum here is just undeniable. There's been a big year-to-date stock surge, and the sentiment scores we're seeing are, well, they're overwhelmingly positive.
Basically zero negative commentary.
Right. So our mission today is pretty simple. Let's unpack what's driving this, and more importantly, figure out what risks the market might be glossing over.
That's the plan. And if you want more deep dives like this one, make sure you hit that subscribe and simplify button. Okay, so that performance.
Let's start with the Q3 numbers, because they really are something. Planet Labs posted revenue of $81.3 million.
Which is a 33% jump year over year.
Exactly. And it didn't just meet expectations, it flew right past them. The consensus was what, around $72 million?
$72.18 million, yeah. So they beat by nearly 13%. That's not a small beat, that's a statement.
And when a company does that, management's reaction is key. They immediately raise their full-year guidance.
They did. To a midpoint of around $299 million. That's management telling you this isn't a fluke, this is the new trajectory.
And then there's the profitability piece, which for a growth company is always the big question mark.
Right, on an adjusted basis at least. They hit $5.6 million in adjusted EBITDA profit.
Which marks their fourth straight quarter of being profitable on that metric. For a capital-heavy space company, that is a huge signal. It shows a clear path.
But the real story, the number that probably has institutional investors really paying attention, is the backlog.
Oh, absolutely. It's one thing to have a great quarter. It's another to have years of revenue already locked in.
And that backlog surged by an incredible 216% year over year. It's now sitting at $734.5 million.
That number is it's massive. And it's not just about financial health, it's about risk reduction. It gives them so much stability to plan and reinvest.
Precisely. And that backlog comes from their competitive moat, which starts with the hardware, the constellation itself.
The Super Dove and Pelican fleets.
Yeah. While other companies are fighting over, who has the sharpest resolution, Planet's whole thing is frequency. They scan the entire Earth.
Right.
Every single day.
And that persistence, that daily refresh of the entire globe, is what defense and intelligence clients are lining up for.
Which brings us to where the growth is actually coming from. Our sources show that the defense and intelligence segments, they drove 70% of the revenue growth in Q3.
70%? That's a huge concentration.
It is. And you can see that as a risk. But right now, with global defense spending on the rise, it's a massive tailwind. They are positioned perfectly.
And they're landing the big contracts that validate the tech, like the NGA's Luno B contract.
And that one is so important because the NGA isn't just buying satellite photos. The contract is specifically for AI-powered solutions built on top of their data.
So they've moved up the value chain. It's not about raw data anymore. It's about selling actionable intelligence.
Exactly. Which brings us to the tech advantage that really locks these customers in. The November 2025 launches were huge, Pelican 5 and 6, plus 36 new Super Doves.
But the really interesting part is the NVIDIA Jetson chip integration. You hear AI at the edge thrown around a lot.
Right.
What does that actually mean for their customers?
It's a game changer for speed. So traditionally, a satellite snaps a huge raw image file and has to beam all of that data down to Earth. It takes time, it takes bandwidth.
Right.
With the Jetson chip on board, the satellite itself can process the image. It can spot a change, a new building, troop movements, whatever, and just send down the small critical alert.
So the time from observation to decision gets cut down dramatically.
Dramatically. And once a client builds their whole system around getting those real-time processed alerts from Planet, switching to a competitor becomes a nightmare.
That's the network effect. That's the high switching costs everyone talks about.
It is. And of course, none of this R&D and fleet expansion happens without a rock-solid balance sheet. They're sitting on $677 million in cash.
And they were smart about how they raised it, too. They netted $406 million from convertible debt back in September 2025.
With a tiny interest rate, 0.5%.
Yeah, that's practically free money. It gives them the freedom to be aggressive without drowning in debt or diluting shareholders to death. They're just plowing it all back into the tech.
The whole bull case is built on that foundation. A data advantage, locked-in customers, and the cash to widen the lead.
Okay, that's a very compelling bull case, but let's flip the script. Let's look at the bear case, which has to start with the gap between those nice adjusted numbers and, well, actual GAAP profitability.
This is the big hurdle for more traditional investors, for sure. Despite the revenue beat and the adjusted profit, the GAAP net loss actually got bigger. It widened to $59.2 million in Q3.
Which led to an EPS miss of negative 19 cents. So why is that gap so wide, especially when revenue is accelerating?
It really comes down to two main things for a company like this. First is stock-based compensation. They have to pay top dollar or top equity to get the best AI and engineering talent. That's a huge non-cash expense.
Okay. And the second?
Depreciation. Satellites are incredibly expensive, and they don't last forever. The cost of building and launching that massive fleet gets written down over time, and it's a huge drag on GAAP earnings. Adjusted metrics strip those costs out. GAAP doesn't.
So the core risk here is whether they can grow revenue fast enough to overcome the constant, massive cost of just maintaining and refreshing their constellation in orbit.
That's the heart of the bear argument. And another piece of it is competition. Planet dominates daily persistence, no question. But the market is getting crowded.
Right. They're not the only game in town. You have players like Maxar who focus on super high resolution.
Or Black Sky, which is really strong in on-demand, real-time tasking. And then you have completely different technologies, like SAR from companies like Capella Space.
Synthetic aperture radar, which can see through clouds and at night.
Exactly. A capability Planet doesn't really have at scale yet, so they have to keep investing, keep launching, just to defend their turf. Any launch failure or delay is a major risk.
And speaking of risk, the bears also point to insider selling.
They do. We saw co-founder Schindler sell about $1.4 million in shares in December 2025. Now, it was under a preset 10b5-1 plan.
So it was automated, not a panic sell.
Correct. But the timing is what people notice. When you see a founder selling after a huge run-up in the stock, some analysts see that as a signal that maybe, just maybe, the valuation got a little ahead of itself in the short term.
It's more about taking profits than a lack of faith in the company's future.
Probably. But we have to put it in context. That risk is cushioned by the two anchors we keep coming back to. The $677 million in cash and that $734 million backlog. That's a massive safety net.
Okay, so let's look forward. What are the key catalysts we need to be watching over the next, say, 30 to 90 days?
Well, first up is the next earnings report, Q4 fiscal 26. That should drop in late February or March.
And the market will be watching to see if that Q3 acceleration was real. Consensus for Q4 revenue is somewhere in the $75 to $80 million range. They need to hit that, or ideally beat it, to keep the story going.
Beyond the numbers, we need operational updates. Those Pelican and SuperDove satellites that launched in November, we need confirmation that they're commissioned, calibrated, and actually generating revenue.
And then there are the rumors, which are always fun.
The whispers about the Owl constellation.
Right. What's the story there?
The rumor is that it's focused on getting to 1 meter resolution, but on a daily basis. If they could pull that off, it would be a huge leap. It would narrow the quality gap with competitors while keeping their frequency advantage.
And let's not forget the macro environment, which is just a huge tailwind for them.
It really is. Defense budgets are up everywhere. There's a big rotation into AI and geospatial tech. And with their exposure to government contracts, they are perfectly placed to just soak up that spending.
So if we pull this all together, the bull case is pretty clear. You have 33% revenue growth, that massive backlog surge, and powerful defense and AI catalysts.
It really solidifies their position as the leader in daily Earth observation. The whole investment thesis is a multi-year hold, waiting for them to hit that cash flow inflection point around fiscal 27. They have all the pieces in place.
So here's the final thought I want to leave you with. Given that Planet is reinvesting every dollar of its $677 million cash reserve into expanding its fleet and its AI, the key question isn't just when they hit positive GAAP earnings.
The real question is what happens after that?
Exactly. What multiple will the market give them once they're sustainably profitable? Will it be the valuation of a high-growth, data-driven software-as-a-service company, or will the market always see them as a capital-intensive space hardware company with depreciating assets? The difference between those two outcomes in 2027 is everything.